Hello and welcome to AI4. Our next session will be led by MEERA Das. She is the Managing Director of AML Modeling and Machine Learning at BMO Financial Group. Please join me in welcoming MEERA to the virtual stage.
Thank you for the opportunity to speak at AI4, and I'm hoping that some of the materials that I'm presenting here today will be of some value to some of you, if not most of you, around how to take a very specific business problem and really using machine learning, how to turn that into really a benefit to the business, cost savings around different aspects of a financial program. And specifically today, it's really around compliance and anti-money laundering. So I'm going to go ahead and share the presentation. All right, so one of the first things I'd like to start with in this presentation is why to use machine learning to solve specifically some of the issues that legacy AML systems have had around false positives. Now, the reason that this is somewhat significant, or I should say why machine learning is really a good solution to use in this particular use case, is that legacy systems have often had a lot of false positives due to the way that the net is really cast. And what I mean by that is that the variables and the way that legacy systems detect anti-money laundering, or I should say unusual behavior within customers, is pretty broad in terms of how they look at the problem and how the solutions are really laid out. And really the monitoring of our customers for potential illicit behavior in financial crime can really use and leverage some of the information that financial institutions have gathered over the years. And a lot of that type of activity is predicated on very specific human-like behavior that can be quantified through variables and information that you already collect at the bank. It's also, to a certain extent, depending on the type of risk and the type of behavior, is a rare event, and it can really have outlying type of behaviors and outcomes where certain machine learning algorithms are very, very good at detecting. So, machine learning to a certain extent can describe and identify the risk a lot better than some of the heuristic legacy systems, because you are looking at it in terms of rules and if-then statements that are very, very specific and broad. So in today's world, really, when you think about it from a financial institution, a lot of money has been spent around collecting and really organizing the data into data lakes or data warehouses, and not necessarily all of the data is leveraged to the full extent that it should. So using machine learning, I mean, we certainly felt that, you could build a better mousetrap, quote unquote, so to speak, that would really, start with these four main pillars in terms of why we're using machine learning. So the first and foremost really is around the expansion of risk coverage. Now, what I mean by that is that, with some of those rules or heuristic rules that I was mentioning, you are very specific around what you are looking at, and very rarely do you go beyond that. So you don't actually know if you're missing true positives. Looking at machine learning and different methods at monitoring this risk, it will allow you to really find true positives that you may not have seen previously. So there is a measurement factor that you can do in that I'll probably end off the presentation with the use case, or I should say case study, that will actually show how the detection of risk actually does increase using machine learning. The second aspect, which is a big thing, but shouldn't be necessarily your primary driver, is around the reduction of false positives. And the crux of this presentation is around really reducing operational costs for compliance programs. And a main driver of that obviously is the reduction of those cases that you really shouldn't be looking at. However, I mean, going to a regulator and saying that is your only reason for doing something is probably not a good idea. So really it has to be in conjunction with that expansion of risk coverage that really should be hand in hand when you're using machine learning. The third thing is really around using better tools to be able to visualize the risk, or even providing tools to your investigators or operation teams to be able to understand the interpretability of the machine learning models and the output that's coming out of it. Now, one of the unique aspects of AML models, or anti-money laundering models, is that there is a human component to it. So once a model identifies, say, a particular customer that is unusual, that output does go to an investigator or an operations individual to determine whether or not it is a true positive or a false positive. And then lastly, I mean, with all of the data that we have available to us, I mean, that is we should be really leveraging that and using that to the maximum ability that we can to cut out a lot of the manual work that is currently happening today. So I think, based on that, you really do have to look at using machine learning for with a very, very strong base of why you need to use it. So moving on to how it is really applied from a detection logic perspective, I mean, the AML models, and this is really an important distinction between credit and fraud and a few of the other different risk areas that utilize machine learning, is that when you develop a model for machine learning and AML, that production model on whatever platform you are using is in fact your production model. We are not going forth and replicating then that logic in sort of like a TSIS or triad or a different sort of credit risk adjudication sort of system. So with AML models, I mean, really when you're productionalizing that model, it will generally be in terms of running your Python code somewhere, or running your model code in sort of an API type format where you can kind of call that model, and then that output will really be a list of customers that you need to go look at. So, I mean, I think there's three things here I do kind of want to hit on, which is a little bit important when you're looking at productionalizing machine learning and AML. So first is really the platform. Now, the platform, and I will get into this a little bit later in the presentation, is how are you consuming your information, in this case, your data. Is it sustainable and scalable to a certain extent? Because at the bank, it is not really a option to be able to run a model off of a desktop using, say, a downloaded version of Python. Now, it's debatable whether or not using complete open source is a good idea. Now, this might be a little bit taboo at this conference, but I mean, I feel that there is a balance between using open source and then a controlled type of environment, so that you can rely on your output, and there's, from a replication standpoint, there's some stability behind what is actually being output time and time again. Now, we have seen this with open source algorithms that we have used previously, where the iterations of algorithms from basically version to version is so different that if you're even running the same model, but with an updated algorithm, your output will be vastly different. Now, with AML, that is a very big negative because honestly, these are regulatory models. They go through a lot of different levels of governance to ensure that the output that we have, or I should say the model that we have designed with the inputs and the outputs are consistent over time. So I think the first thing there is just understanding your data sources, understanding your platform that it will be deployed on. And then the second part here is really around the output, because I alluded to this on the last slide, where your production model is that model that you're building on whatever platform you're using. Let it be Data IQ, let it be SageMaker, let it be whatever tool that you're using. That will ultimately become what your detection model will be. So you need to be able to have a facility to take that output and put it into a system where all of your investigations and all of the evidence around what has been found unusual is kept. And then finally, you do need to understand how that feedback from that human element is going to impact your models and your optimization of those models ultimately. So that feedback loop really does help machine learning models get better, not just from self-learning, but also from taking that output and incorporating it back into a challenger model that may eventually become a champion model. And I think, you know, one other point I do want to make here is that you definitely, at least at most institutions, you will not find self-learning algorithms. And the reason for that is really from an interpretability perspective. I think you need to be able to explain very, very succinctly what your models are doing and how they're impacting the output. So, I mean, I think that that's a very important consideration again on the model inputs, because instead of taking just random data, you know, that apply to your customers, and when I mean random, I mean just everything under the sun, you do have to be very specific about the features you're selecting as model inputs. So if you are looking for a very specific type of AML risk, it's a lot easier to be able to explain that output if you've really interrogated those features to really map back to the risk that you're trying to monitor. Now, the types of algorithms that we use and really how do we implement them. So, I mean, everyone who works with machine learning will obviously understand that there are different types of algorithms depending on the type of model that you need to build. And really, it depends on the business problem at hand. And in financial crime, there is much debate over whether unsupervised learning is too nebulous for things like AML or fraud, because you do have, in order to really implement that, you really do have to do a lot of testing around the groups of transactions that are generated in terms of segments. Now, they're extremely, extremely good at identifying outlying transactions. I find that in order for it to be implemented in such a way that your operation teams will understand, you need to still narrow down how your supervised algorithms will determine what is unusual. So part of the reason why I think a lot of banks shy away from using this is, first of all, they don't want to explain why there are true positives that their traditional models didn't find. I mean, I think that that's usually at least part of the bias. I also think that it's a very expensive way of having to do testing. Because when you look at unsupervised learning algorithms, ultimately, regardless of the algorithm that you're using, it will classify all of your data elements into very specific groups. In order for you to determine which groups you want to productionalize, you need to test every single one. So, you know, when you have lots and lots of different segments, it can get very expensive to test. And then, you know, computationally, depending on your size of data, it can also be very expensive, because synthetic sampling is something that is, you know, it's gaining traction a little bit more, especially in unsupervised learning, because it enables you to actually, you know, consider every single potential alert or customer or case. So there are no basically exclusions from what you're training your model on. Now, with synthetic sampling, I mean, it does have a tendency to overfit your model and things like that, but it gives you a very comprehensive base. So, I mean, unsupervised learning, certainly if you feel that your traditional or your current models aren't giving you what you need, it is a good way of actually testing that hypothesis and determining whether or not there are anomalies beyond what you've already seen that you want to move forward and detect going forward. Obviously, with supervised learning in AML, depending on the type of risk, you certainly do and you can use supervised learning to find more types of cases or customers that you've seen before, because they have been, you know, extremely productive. A good example of this really is around cash type transactions, where historically in money laundering, because it's an unknown source of funds, there is a high bias of actually saying that something that is, you know, induced by cash is very unusual. So you end up with any sort of cash monitoring to have quite a few basically targets that you might be able to run an algorithm off of. So with supervised learning, though, you do need to be careful in terms of what you're defining as a target, I find. But if you have enough targets, it is certainly, you know, a method that is very, very good at least isolating out those false positives and just looking at what you would consider as an institution as a true positive. Now, in terms of algorithms and the types of machine learning algorithms that we found have been very, very useful, you know, with all of the different types of algorithms out there, it usually does come back to a couple of very specific ones for each category. So for unsupervised learning, really isolation forest has been one that has given us extremely good performance over the last year or so. Now, it doesn't mean that we will not explore other algorithms. It just means that that one, from a testing perspective, has given us very, very good results. Also, I mean, if you look at supervised learning algorithms, really random forest and SVM have been two of the ones that have also given us very, very good results in terms of output. So moving on to just the detection development cycle, I'm going to not really focus on the entire life cycle here, but just some components of it. That for regulatory models, there are very specific things that will have impacts on your machine learning that will really impact its output. Now, the risk identification obviously is one of them. And that is one thing that regulators certainly look at. Investigator feedback we've talked about, because that will really help optimize, you know, some of the model output and basically what it generates. But the one other thing I do want to bring up here is really around model validation, because any large institution will have a model risk management program that all of these models need to go through. And really from a regulatory standpoint, if you are able to get your model risk program to validate your models, it really does lend a lot of support to your program and how you're using machine learning. Now, a lot of vendor sort of programs and I should say applications focus on algorithm selection and testing and tuning. Unfortunately, they don't necessarily look at the rest of the development life cycle. But I think these are all the main components that are needed in order to really lend some credibility to how you're using machine learning for regulatory models. Lastly, I mean, I just wanted to talk a little bit about all those different aspects in terms of how you can scale your machine learning. Again, I think some of the things that need to be considered is around minimal disruption, transparency around how the decisions were made, documentation, the fact that you can replicate a lot of the different outputs that you're getting, how the interface works, and then obviously some of your integration with your hardware. I mean, I think you can't really minimize that. I think to end the presentation, I just wanted to walk through very quickly one of the use cases that BMO had basically implemented machine learning in comparison to legacy. Really with a vendor solution, it is an out-of-the-box sort of solution. And the comparison I like to make, it's akin to buying a suit or a dress off the rack versus getting a custom bespoke suit with a internal solution. Now, our internal solution, using machine learning, had, in comparison, probably around 70 to 80 different features in comparison to maybe 7 or 8 with the vendor solution. So if you think about that from the example I provided, I mean, that's a lot more measurements to really go off of. And from a cost perspective, it is a lot more cost effective. So I think this is, again, coming back to how cost savings can be driven, where vendor solutions do have their, they do have their place, and they do have their point in time sort of applicability where you do need to sometimes use one of those solutions. But if you're really looking at balancing that risk management and really finding those things that are important to your bank, that may not be a sustainable long-term solution just due to the cost. So from an infrastructure perspective, I mean, there is a very big difference between going with a custom machine learning model that you've built versus a vendor solution. And then finally, from an impact of implementation, this sort of compares the two solutions over time. And if you look at that blue line, that really tells you how many alerts, quote unquote, that we call as an output coming out of the model, where at the beginning of 2017, this really was the vendor model. Going into the end of the year, which is the machine learning model. And really, if you look at that, that's where the majority of your operational savings will be. So I think that really, in conclusion, shows you how costs can really be reduced by using machine learning.
Wonderful. Thank you so much, MEERA. A big virtual round of applause for you and that incredible session. All right. If you are looking for your next session, you can go ahead and check out the program page or take some time to connect with your peers with virtual networking. Thanks so much, and we'll see you around.